Bloomberg Quint.
Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Shah and you're watching IndianOpen. Let's go straight to the headlines. The Supreme Court allows construction to resume in the states of Maharashtra and Uttarakhand, asks two other states and the Union Territory of Chandigarh to submit their proposals. The Delhi High Court asks Balwinder Singh to deposit 3.5 million Singapore dollars after Daiichi accuses him of selling stake in Religare despite a stay. India's Defense and External Affairs ministers will begin talks with their US counterparts as part of a 2+2 talks today. And the Supreme Court will pass its verdict on the crucial Article 377 today. Boy, and do a bunch of Indians hope that the verdict comes out on the right side. We'll get to know about it at 10:30 though. Anyways, let's take a look at the trade setup for the day first. The news around the world, tech saw sell-off as Nasdaq ended lower in trade. Frankly, if you look at the US markets, the one big standout feature of trade yesterday was what happened to the tech names. And be it anything from Twitter to Netflix, which actually led the route lower, or even an Amazon or a Microsoft, all of them ended lower. Netflix and Twitter, of course, had the highest losses, about 6% apiece. And which is why if you look at the S&P, Dow and the Nasdaq, you will see that Nasdaq had fallen about 1%. The S&P and the Dow, not so much. In fact, the Dow ended in the green. And despite Europe ending about 1% in the red, the rest of the Asian pack don't have too much of a disruption in the session today. In the US, again, the 1-month US Treasury yield closed above the 2% mark for the first time since June 2008. So if people needed some evidence of there being a reason for the Fed to go ahead and hike, you keep on getting these smaller reasons and smaller upticks in the yields every now and then. Now, whether this 1-month US Treasury yield really is a determinant to know is a separate question altogether. But in the minds of the market, all of these cement the fact that we will have arguably the 8th hike in the US markets in the next month. So that's something, or in the current one, that's something you need to watch out for. What's to be watched today, by the way? I think what's more important from a global markets perspective to watch today is what's happening in the US. So two key things to watch out for. One, I think the next round of the US-Canada negotiations, and that's something which we should see culmination today. So that is something on the minds of the markets for sure. And there was a public comment about how the public comment period, once it ends on the Chinese imports, Donald Trump over the weekend has said that he's ready with imposing the tariffs. It almost seems as if, irrespective of what the public comment outcome is, Donald Trump will go ahead and levy tariffs on $200 billion worth of Chinese goods. So this is a very, very important piece today, what happens on both of those counts from the US markets perspective, and thereby naturally on what happens to world markets as well. What happened to our markets? It was a day of recovery yesterday, frankly, a mirror image of what we've seen the last 3 sessions, because yesterday we saw the last one and a half hours really pick up in trade, more so for the Nifty Bank. And I think, to my mind, that remains the key pivot in trade today. What happens to the Nifty Bank? It almost broke into the green yesterday. Can it do more in the session today? That will be key to watch out for. Remember, we also spoke yesterday at close about how the volumes had shot up in trade ahead of the Nifty Bank expiry, of course, but it was a normal day of trade. But NSE F&O volumes were to the tune of 13 lakh crores. NSE cash volumes were 37,000 crores. Now, I've seen massive positions in index futures and index options, but we didn't see so much of cash market buying or selling from FIs or DIIs. This would presume that there were some large bulk deals that would have happened, and the HNI community was very, very active in trade yesterday. A lot of stocks in news too yesterday. So I'm guessing it had to do with HNI activity and retail activity, not so much institutional activity in trade yesterday. But the volumes were very high, both on the F&O side and the cash side in trade yesterday. Difficult to draw conclusions out of it, but just marking that point. Today is the Nifty Bank expiry. Anyways, expect volumes to be higher. However, amidst all of this, what's to be watched out for in the session today? 3 or 4 stocks TCS may not really react too much, but it's the onset of the buyback period, September 6th to September 21st, the stock in and around that buyback price as well, which I'm seeing. I don't think there'll be too much of a reaction thereof, but watch out for TCS. But there will be a reaction on Vindhya Telelinks and Gallant Ispat. Vindhya Telelinks in particular, it's a stock that's had a very good move over the last 9 to 12 odd months. Both of these stocks placed under the ASM category. Expect some reaction in these stocks today. Could NMDC react positively to the JP Morgan note? The markets have a setup for it because we're likely to start off well. JP Morgan has raised the NMDC target price to 145 from 130, which potentially gives about a 30% upside to the NMDC stock. They maintain that the domestic iron ore pricing strong on pellet pricing and the domestic steel pricing, and the market is not giving any value to the steel investments of NMDC, which JP Morgan is assigning about a 45 rupee per share value to. So a couple of reasons why JP Morgan believes NMDC is a stock to monitor. Do watch out for that. And Nandan Denim, they've given out some positive statements about the monies that they are liable to receive, or they are eligible to receive, let me put it that way, because they've received some sanction of subsidy which saves them about 65 crores over 5 years starting 2016. So again, accounting about what would happen to them. So that's something you watch out for. They've said that they are entitled to some GST and VAT refund of up to 340 crores till 2024. Let's see if all of these bring about some reactions in the stock price of Nandan Denim. And last but not the least, something that I've not marked here, but Bharti Infratel could be interesting. We now know that there is an outcome of what's the number of tower assets that will be vacant post the merger of Vodafone Idea. It probably brings to culmination and brings some certainty to a number that was floating around in the market. The stock is corrected quite a bit already. This brings about a floor to the expectations that the market had with regards to the number of tower assets that will be vacant, and therefore might be viewed as a mixed bag, maybe reasonably positive as well. Let's wait and watch if that brings about a reaction in Bharti Infratel or not. So 4 or 5 names that I thought would be important. We'll of course talk about all of these during the course of the show as well. But time now for First Word, and let's tell you what's lined up on First Word today. Darshan first joins in to tell us how some of the Indian pharma giants have performed in the US in August based on the IMS health data. It's true, airfare on some of India's busiest routes are cheaper than train tickets. Sameet comes in with those numbers. Nikki then tells us why Indian aluminium players may be in a sweet spot right now. And as Nirmala Sitharaman and Sushma Swaraj get set to sit across the negotiation table with the US counterparts, we take a look at what could be on the agenda. Well, a lot's been said about the regulatory hurdles plaguing pharma majors and even the tailwinds from the rupee depreciation. But how about the core business? That's the key, isn't it? How are some of their drugs faring in the mother market, or in fact, all of the markets? Darshan has gone through the market share data put together by IMS Health to figure out just that. Good morning, Darshan.
Good morning, Neeraj. Let's take a look at, this is basically the IMS data. This is, we've taken it from multiple brokerages, Bank of America, Merrill Lynch and Morgan Stanley. It's a paid data, so we have to rely on their data. So basically, all this data gets consolidated at IMS, and then this data comes in. Now, this is at the end of July because the data comes in with a 1-month lag. Now, which were the beneficiaries? So, Aurobindo Pharma, Glenmark Pharma, Cipla, as well as Sun Pharma came out with drugs as far as the overall market share in the US that did well. What didn't do well was it has to be Cadila Healthcare, not Cadila Pharmaceuticals. There is Lupin and as well as Taro. So basically, these were the 3 companies that came out with share, which came out with drugs which have actually lost market share. Now individually, let's take a look at first all of them. Sun Pharma, the biggest company, their product Glumetza they launched recently. The market share is now 5.2%, which is decent for them. Glivec market share, the erosion continues, so that's not very good of them. And the Suboxone tablet market is currently at 1.3 at 13%. So this is the market share for Sun Pharma. The other companies that we want to talk about is Lupin. Now, it's a good thing that the Fortimet and Glumetza market share is stable at this point of time. So Lupin has corrected all the way from 2,000 right up to 700 on the back that these two were their main drugs and they saw competition that came in. Now it's managed to stabilize at a level. It's not seeing any kind of decline as far as the July sale is concerned. Exiron is, after they've had weeks of sluggishness, it's currently at 5.6% currently. So for Lupin, it's decent. The other company that we want to talk about is Cipla. So they launched this Sustiva, which was a new drug. They got a market share of 6.3%, so that is good. And couple of new products that were launched, but we don't have the market share data for Cipla on those drugs. The other companies that we want to talk about is Dr. Reddy's. It was rather flat for them, nothing, not positive, not negative. It was rather flat for them. The injection is yet to see any kind of pickup, and they managed to maintain market share in some of their larger drugs that they have. So that is as far as Lupin is concerned. Aurobindo Pharma, it's been a good drug year for a good month for them. Viagra, Reatas, all of them, the market share is improving significantly. And because of volume gains in certain products, they've managed to come out with decent set of market share. The other company that we want to talk about is Cadila Healthcare. Toprol was launched this time around. The data is not updated yet at this point of time. Lialda, which is their biggest drug, the market share is stable for them. And the other companies, on the back of these two important drugs, it's a seasonally weak quarter, so they will be losing market share on those drugs. As far as Glenmark is concerned, it's been a good month for them. Welchol, which is one of their key drugs, that has shown a market share gain of market share of almost 19%, so that is positive for them. And the final company is Torrent Pharma. Good share, market share for Viagra has been raised to 17%, and the new launches have been fairly stable. So for most of the pharma companies, Neeraj, it's been a decent July. Probably that should reflect in their quarter earnings that come out, given the fact that over the past few quarters we've seen weak trends in the pharma share. But this gives an indication that again, share is improving, and the US business is becoming far more stable for the Indian companies in the US.
Anything that stood out better than estimated, Darshan?
No, pretty much as it was in stable. I think Glenmark Welchol was very good for them. It's trading at record highs currently, so that was an important drug that is there. And secondly, Lupin, Fortamet and Glumetza, which have been their key drugs, and they've fallen significantly because they were the key drugs. They were earning money, and then competition came in, and that's why the big correction that came in. Now they managed to stable their market share, so that is the second important point.
Great, thanks, Darshan. Thanks for putting this into perspective. Not data that's easily analyzed or available for that matter. So do watch out for some of these trends, really, not necessarily stock reactions. But important trends nevertheless. Important trends in aviation as well. Jayant Sinha made headlines on Tuesday when he said an auto ride cost more per kilometer than a flight on some busy routes in India. That prompted us to look up exactly how much it would cost to take one of the premium trains in the country to travel on these routes, and the fare suggests that it's definitely much faster and cheaper to fly in India. Sameet's here with the comparison. Sameet, really interesting. Tell me about some of the routes. I'm inclined to fly them ASAP.
So the first route that we checked was from Mumbai to Delhi, which is the most busiest route in India. And you can see here the flight rate on this route ranges in the close to around 2,200 to 6,400 rupees. Now this is if you book the tickets 15 days prior to your journey. And if you see the real ticket prices in this route, it's close to 2,400 to 4,700 rupees. So you can clearly see here the minimum ticket price by traveling by air is lower than that of traveling by railway. The second route that we checked was from Mumbai to Kolkata. And this route, an air ticket would cost you anything in the range of 2,900 to 4,000 rupees, while a railway ticket would cost you anything in the range of 3,000 to 6,100. In this route, both the minimum and the higher base price is lower than that of a railway ticket for an airline ticket. And the third route that we checked was from Mumbai to Bangalore. Now in this route, a flight ticket from Mumbai to Bangalore would cost you something in the range of 1,800 rupees to 5,000, while a train ticket would cost you something in the range of 1,300 to 3,400. Now the fare here is higher than the railway ticket prices, but a person who's willing to spend 3,400 rupees for a 16 hours journey would definitely spend 1,800 rupees to reduce its journey time to around 2 hours. So that's what the ticket prices have been. Now, this ticket prices have definitely led to a double-digit passenger growth for the aviation market, but that is not a profitable growth because the cost for the aviation companies are still rising. Now, why this ticket prices have fallen drastically? Well, it is because of the increase in capacity, and by capacity I mean the available seat kilometer. As you can see here, in 2008, the total available seat kilometer, average monthly total available seat kilometer in the domestic market was close to 51 lakhs, which increased to 1 crore in 2017. And in 2018, compared to 2017, it has again increased by 20 lakhs to 1.2 crores. So this fast rise in capacity addition has made an aircraft seat into a perishable good, thereby forcing airline companies to sell these seats at a throwaway prices. Now, who led to such kind of disruption? Well, it was the market leader Indigo. As you can see here, from 2016 to 2018, Indigo's average monthly available seat kilometer has increased by more than 10 lakh. It has increased by 39 lakhs to 49.7 lakh. And the addition that Indigo has done is higher than the combined addition done by Jet Airways, Air India and SpiceJet, and also higher than the combined addition done by these three smaller players, that is Go Air, Air Asia and Vistara. So you can see the kind of disruption that Indigo is doing in the aviation market by adding more and more aircraft and seats in India.
Very interesting. So this clearly puts into question this whole argument that people had about secular growth in aviation, right? You have monthly sales numbers which are looking very, very strong, but that's not happening at one, maybe optimum capacity utilization levels, though I think they were high until last month, but two, not happening at the fares which are desirable too. Right now the sales are on, I presume.
So what is happening now is they're adding more and more seats. They're selling it at a throwaway prices, because of which the utilization levels are also remaining at a high point. That is around 90%. Huh?
95, 96%?
Yeah, close to 90% on an
average.
Close
to 90% on average.
But that is not profitable, because the revenue that they're generating on each seat, that is falling for them. So that is not a good thing, because the cost that is there is still increasing and still on a higher side because of rupee depreciation and because of rising fuel costs. So it's not it's a growth, but it's not a profitable growth for the aviation companies.
And it's showing in the way the stock prices are behaving as well. Interglobe Aviation down another 4% in trade yesterday. Okay, Sameet, thanks for putting this into perspective. Very nice color piece as well. And hey, so here's the logic. If you are indeed looking to book tickets to these three routes from Mumbai, maybe you want to consider looking up the fares on any of the websites as well. Maybe, just maybe, the airfare might be cheaper than the train ticket. The next piece on First Word, the world's still not getting enough aluminum, at least outside China. The total deficit in the first 6 months of 2018 stood at 1.5 million tons, according to a JM financial report. And the situation doesn't seem to be changing in a jiffy. Nikki Mirchandani is here to tell us if Indian players like Hindalco and Vedanta can capitalize on the situation right now. Nikki, good morning.
Hi Neeraj, I'm going to start off with the two key reasons for this phenomenon. First is the world ex-China deficit. That's almost moving higher as compared to what we saw in the calendar year 2017. Now, flat production growth in light of the increasing demand that we have. There are negligible capacity additions which are going on across the globe, because of which the deficit is growing. And also the aluminium producers are expected to report in a deficit ex-China. The world ex-China is expected to stand around that 2.1 MT as compared to 3 MT as compared to what we've seen at around 2 point something in CY17. Now, most of the producers notably suggest that the deficit could be around the 2.1 level. But then, we are estimating a higher, or rather this report is estimating a higher deficit at around 3 MT, given that for first half of the annual year, first half of this calendar year, we looked at an aluminum deficit around 1.5. So if you kind of analyze that comes to an estimate of around 3 MT. And also if you look at the China surplus, now that's almost halving to what we have seen as compared to the previous year. Now, if you look at the surplus figures that we're looking at, it could, for estimated, it as per the JM financial report, is expected to be around 0.8 MT as compared to nearly 1.5 MT that we saw in 2017. That's mainly on account of the production growth, which on YTD basis is around 3% as compared to 10% overall growth that we've seen in 2017. Apart from that, we're also seeing some kind of illegal capacity curbs, which is further going to offset the kind of production level from the smelters for the overall production capacity. And if you look at the trend which has been moving across for overall aluminium, on YTD basis, aluminium prices have corrected as much as 9%, and on yearly basis they've slid around 2%. But then, Neeraj, if you look at the overall base metal basket, aluminium prices relatively have shown some kind of resilience as compared to the fall that we've seen for other base metal prices. So that's something, and also we're expecting some kind of further uptake coming in from the aluminium prices on account of three key reasons. One is the China shutdown, the China winter capacity shutdown, which is going to be coming down, and you have the failure, if at all, in US Rusal negotiation deadline, which is going to be coming coming in on October 23, 2018. Now, remember the fact we've spoken extensively about how the sanction had been levied on the Rusal, post to which we saw some negotiation happen, and the deadline was extended until October 23rd. So any failure to that will have a bearing positively on aluminium prices. And also we're seeing a sharp rise in their raw material prices, be it in terms of bauxite, be it in terms of alumina. Obviously, the players would want to pass on.
And they will be able to pass it on as well.
Yes, and if you look at the sensitivity analysis, now if the aluminium prices go up, which are the players that actually stand to gain from this kind of development, you have NALCO topping the list, and that is why perhaps the reasons we've seen most of the brokerages giving a bullish call on the counter. So for every 1% change in LME prices, EPS change for NALCO would be 3.8%. For Hindalco, it'd be 2.1%, and for Vedanta, that would be 1.3%.
Okay, so the stage is set for the prices to rise if any one of these three factors or all of these three turn out to be true.
So all the three factors turn out to be true.
But Rusal, we don't know if the negotiations will break down or no, right?
Correct.
Yeah.
But any of these, yes, one of these, at least two of these are coming in true. Input prices are on rise, and we are also looking at the winter cuts coming in from China. So 2 out of 3 factors are already a given. If the sanctions on Rusal happen, that is something which is going to be extremely bullish for aluminium industry as a whole.
Okay, I just have one last question. The street is working with overall deficits still of about 2.1 MT, not 3 MT.
Yeah, so the estimate is around that 2.1 level, but then,
but if it actually comes out to 3, then that's a bit of a further trigger to aluminum prices as well, possibly.
Yeah.
Okay, let's wait and watch. Maybe that's one reason why they are resilient compared to some of the other base metals as well, Nikki.
Yes.
Okay, thanks for putting this into perspective. Very interesting piece of analysis. So, hey, for the last few days, we've been talking about how NALCO, at least sporadically, has been on fire. Well, some of the reasons outlined here by Nikki Mirchandani. That stock 4.5% in trade yesterday as well on 13 million shares traded, by the way. Do watch out for the aluminum players for the rest of the year as well. The last piece on First Word. After 2 delays, the much anticipated 2+2 meet between India and the United States finally begins today. The 2-day meeting will see Indian Defense Minister Nirmala Sitharaman and External Affairs Minister Sushma Swaraj meet with their American counterparts, Secretary of Defense James Mattis and Secretary of State Mike Pompeo. This is the first high-level meeting of this nature between the United States and India, and comes at a time when trade tensions and American sanctions have cast a shadow on the relationship. Bloomberg Quint's Tamanna Inamdar spoke to former Ambassador Ashok Sajjanahar and JNU Professor Rajesh Rajgopalan to understand just how important this meet really is.
This is the highest format of interaction between India and the United States. And the objective of this meeting is how to deepen and to expand the cooperation, whether it is in strategic terms, it is in defense terms, it is across the board. And we can see, both the countries can see that there are a large number of challenges that confront India, that confront the United States in the region and in the world, and how the two countries can work together. More recently, we also have had issues like CAATSA, that is countering America's adversaries through Sanctions Act, and the purchase of S-400 Triumph missiles from Russia. That has come under a cloud. Also has come under a cloud oil imports by India from Iran. So these are some of the things, some of the, let me say, the contentious issues which have emerged in recent months, which will be a focus of discussions. And of course, there are a large number of positive areas, whether some of the decisions that we have seen more recently, the upgradation of India from STA2 to STA1, the strategic trade authorization 2 to STA1, the naming of Pacific Command as Indo-Pacific Command, the launch of Quad once again, the greater use of Indo-Pacific in place of Asia-Pacific. Yeah. So I think there is greater convergence between the two countries. So both the positive and the more contentious issues, all these are sought to be decided to put the relationship on an even keel and on a faster track.
You know, it's interesting because you spoke about some of the contentious issues, and there's a quote from Mike Pompeo before he left. Of course, he's stopping by Pakistan first, where he says that, of course, Iran and the sanctions on Russia will be discussed, but they're not the only priority. Rajesh Rajagopalan, that's all well to say. Before Pompeo gets in a room with Sushma Swaraj and, of course, James Mattis and Raksha Mantri Nirmala Sitharaman. But how much of a play are these sticky issues, especially Russia, considering a recent statement from a Pentagon official saying that India should not, expect a guarantee of an exception from CAATSA. There are sanctions, American sanctions on Russia, and they would naturally extend to India if we continue with our purchase of the S-400 missile system from Russia.
Yeah, I think that issue will definitely be discussed. I don't think that will be ignored in this coming discussions. But we have a lot more to discuss, not just those. I think those issues will have some priority in terms of the fact that they could damage our relations going forward, and also in terms of negotiating how they might be dealt with, because as the Pentagon and the US government has made clear, the fact that there is an authorization that allows the president to waive some of these sanctions doesn't necessarily mean that they will actually do it. It is not actually a waiver that we have got. It's only an authorization for a waiver for some of these sanctions. So we will have to, there will definitely be some negotiations in terms of what India can give in return for the US government waiving these sanctions, at least temporarily.
Well, important ones. We'll watch out for all of these, but that's all that we have on First Word today. Lots more lined up on Indian Open. We discussed Dabur's pricing and product strategy for the upcoming festive season with CFO Lalit Malik, and Varroc Engineering came out with its June quarter earnings yesterday. Its first report after listing. We decode the numbers with the CFO, TR Srinivasan.
Good news, got a promotion and a damn good raise.
Congrats बेटा।
वाह, रेज अब तो इंश्योरेंस पॉलिसी ले ले।
कौन सी कंपनी से लूं?
चूज वही जिस पर हो पूरा भरोसा।
That's good. But आज की जनरेशन wants everything online. Easy premium payment options, loan facilities और wide range of products.
पापा दीदी, I will decide. Just send your links now. तुम दोनों भी ना, same choice. LIC.
LIC, trending with times. 62 सालों से हर जनरेशन की पसंद।
The heart wants what it wants, and mine has led me to some amazing highs and lows as I followed its guidance from software development to investment banking and then into my own startup. I am Ahmad Aftab Nakhri, and my journey has been a roller coaster ride. When I started my company with a single laptop in a garage and 2 friends armed with just the burning desire to create something, I had no idea that we would create a whole new paradigm of marketing. Today, Gozoob is at the forefront of the industry, a thought leader in the space, and voted as one of the best places to work for in India. But we didn't get there quickly. But everything taught me and engineered our success. It's an interesting story, and I'm really looking forward to sharing it with you.
Aegon's of business never stop. Only on Bloomberg Quint.
September 15th, 2008. The day a titan of the investment banking world fell. An event so unlikely that when it happened, it shook the world economy. 10 years later, the world has picked up the pieces. Or has it? Bloomberg Quint looks back at the collapse of Lehman, its aftermath on India, and the recovery that followed. Lehman, a decade later, starting Monday, September 10th, all through the week.
Good morning to all of viewers. You're watching Indian Open right here on Bloomberg Quint. Let's take a look at what's been happening in the Asian market back before we head across and take a look at our market setup. So Nikkei 225 is trading lower by 0.25%. It's a mixed bag session this morning, with Shanghai trading higher by about 8 odd points, Hang Seng lower by about 0.33%. This in tow with what's been happening in the US. Remember, over the last few days, we've been seeing pressure building up across markets, not just within the Asian market pack. So you had the S&P 500 slipping. 2 days back, it slipped below 2,900, is still under pressure. Nasdaq also down by 1.1% on the back of the heavy sell-off in all the technology stocks that we saw in yesterday's trade. SGX Nifty and our market setup shows you a slightly more positive start. So 11,538 on the SGX Nifty. Remember, yesterday's session, Sensex in particular breached that 38,000 mark on the downside briefly towards the end, just about managing to scale back up to 38,000. Nifty still under pressure, about 0.33% cuts coming there on the benchmark indices. Let's see what happened in the futures and options space. Agam is joining in right now to take us through all of those. Agam.
Good morning, Devina. What we're seeing actually is a little bit of a reversal or a retracement of the benchmark indices. As you can see, we've seen about 0.4 of a cut here when it comes to the Nifty, and of course the open interest has surged towards fresh shorts coming through. When it comes to the Nifty banking futures too, well, we are seeing unwinding coming along when it comes to the open interest for the September futures. India volatility index coming through has actually declined surprisingly, considering we did see some amount of weakness. This is largely to do with some unwinding coming in options, and that will be evident in your change in open interest when it comes to your several options. As you can see here, we've seen unwinding in some of these puts, such as the 11,600 and 700 puts, but more writing around the 11,400 and 500 calls, and that perhaps is not necessarily a very good sign, considering writers coming through in these relatively lower levels. Let's take a look at some of the other variables. The Nifty put call ratio at around 1.37. It has also come off understandably, and in terms of stocks, we're watching out for something like a Muthoot Finance, which did surge yesterday on the back of strong earnings. Open interest moving up by around 44% longs there. And among others, we have the likes of Nalco, which is also continuing to advance, now at around nearly 77. And so fresh longs there. And we also have Bharat Electricals on the losing end, 13.5% drop. Shorts build up even as we see a surge of nearly 52% in open interest. So mixed cues coming through. And once again, today's day of trade will determine how we see the benchmarks along with the broader markets come through going in.
All right. Agam, thanks very much for joining in with that. So that's the F&O snapshot for you before we enter trade this morning. We've got Parthiv Shah, director at TRACOM Stockbrokers, who's joining us on the show right now. Parthiv, good morning to you. Last few days have not been particularly encouraging. We've been seeing, consolidation, not big steep cuts, but still, do you see this as probably a time to enter at lower levels for specific stocks, and which would those be according to you?
Very good morning. Certainly, I think we were also of the sense that the markets, even here, despite the couple of days of correction that we've seen, the valuations certainly has stretched. I think the Indian markets are pricing in a very good possibility of good micro data, wherein Q1 certainly was a good quarter. But I think we should also not forget the fact that as on date, I think the macros are not particularly very supportive. And if you were to look at the sensitivity analysis of the Indian companies in terms of how they do in terms of the results, especially at an environment when the interest rates inch up, I think it's not a very good report. So in that sense, I think one will have to definitely make sure that whatever portfolio is built post this correction, or whatever sectors that we are entering into, I think one will really have to cherry pick in terms of the valuations, because I think this market overall, if I have to see from an index per se, or for that matter many sectors, many stocks, I think the risk reward in terms of the valuations is not there. Even if the earnings were to catch up to the tune of around 15 to 18%, I think a lot of goodness seems to be priced in. So we are certainly looking for better entry points in many of the sectors, but particularly I think if in this market we have to select a few sectors, my choice would be some of the old economy sectors, something like capital goods. It's not done anything over the last 3 to 5 years. And I think a lot of value is starting to emerge. We are seeing some signs of private sector capex. And I think in terms of the capital goods, you have stocks like L&D, you have stocks like Cummins India, Greaves Cotton. I think these would be a very interesting stocks that one should definitely look into in this particular market.
Interesting. Parthiv, good morning. Neeraj here. Lots of stocks in news today. I want to first talk about a couple which came out with news yesterday and were very active. BEL. Has what's happened leave a sour taste in the minds of investors? And because of this, would companies like BEL virtually become untouchables? You don't want to go out and invest in a company wherein you don't know if normal business practices will be adhered to over the course of time.
Very good morning, Neeraj. Absolutely, Neeraj. I think it leaves an extremely sour taste. And I think as such, in the defense basket, I think defense is a sector we all are bullish on. But I think very few selected plays. BEL was one company where everyone thought that, this being the giant it is and the execution capability that it has, I think the last thing you'd want to see is some sort of government intervention. Yes, I remember my days when I'd gone for Bharat Dynamics Limited IPO meet, and at that point in time, the management did say that, the government will not allow us to kind of earn endlessly. They'll put some cap in terms of our earning, but the key driver for our growth would be the exports, wherein the government would want us to squeeze in the maximum profit to recoup whatever loss that the government would ask from them. But I think coming from BEL, wherein I think this company is not only into one or two segments of defense, I think there are plethora of verticals that they cater to. And I think no doubt it's a cash-rich company, is still going to generate a lot of cash even at a relatively lower margins that they start to earn from the FY20 onwards contracts. But I think any business, wherever there is any sort of government regulation, where the government, I think for its own sake, because of the fiscal issues, in terms of their budget defense spending, were to even make a statement like this, though it's going to be implemented post kind of FY20, because most of the contracts are before that, I think certainly SARS it is. And yesterday's 14% reaction was something that, the markets really showed that any sort of government talks in such sectors. And mind well, I think defense needs a lot of R&D and a lot of gestation period. And then over and above that, if the government were to talk about this for public sector companies, I think doesn't bode well for the valuations. Hopefully, this same thing does not percolate into many of the private sector companies which are geared up for a major defense contract overhaul going ahead in time.
Parthiv, just come in on Bharti Infratel. I mean, the exit notices for about 27,500 odd co-locations post the Vodafone and Idea merger. Implications of about 780 crores on an annual basis. Do you see that overhang which was already built into the stock price, or there could be a correction that further comes into the stock?
My sense is that in this particular company, if we were to look at the business model, it is more of an annuity sort of a business model. And I think whatever weakness that we're seeing in the stock, I think it does tend to factor in a lot of negativity in terms of the news. And I think my sense is that going ahead, I think the tenancy ratios should improve. The only reason being this infrastructure is a very difficult business setup, and not many companies are able to do it very successfully the way Bharti Infratel is done. And most importantly, this is a sector, thanks to the geo competition, we're seeing a lot of consolidation. And I think consolidation even in the tower segment is always very healthy. We see companies like American Tower Corporation wanting to bid relatively rich valuations for acquiring tower assets. And I think companies who are having stable business model like that of Bharti Infratel might not be multi-bagger stocks, but I think certainly based on the business model going ahead with the advent of even 5G and more data consumption that we are seeing in our country, I think the tendencies will go up, and I think I'm expecting this stock to deliver something like 15-16% compounded over the next 5 to 7 years.
By the way, we obviously can't ask Parthiv ad nauseum about Bharti Infratel for a longer period of time, but for all of you who are interested in understanding the rationale behind Bharti Infratel as a business, do log on to the website bloombergquint.com. There is a tab which says Alpha Ideas, and there is a presentation by a private equity investor, Gordon D'Souza, on why is it that he's bullish on Bharti Infratel. Don't take it at the face value, but it gives ample rationale of what Bharti Infratel as a business could do over the next 10 years. So do log on to bloombergquint.com and try and take a look at that presentation.
Infratel yesterday beaten down badly, 4.5% amongst the larger names. Let's put the thought on hold and go across to our research team right now. They're all here with us to take us through a few more stocks that we need to keep a track of as we start off in day's trade. There were some numbers that came out. So there was Hutco, Shrey, Infra, and there's an MS report on Z's. We've got all of that and more lined up. So let's start off with you, Shraddha.
Two sets of numbers which were reported after market hours. Hutco, very good set of numbers from the company. The net profit has more than doubled to 333 crores. A part of that, of course, has to do with one NPA account which saw recoveries post NCLT resolution. But provisions were also more or less steady at 248 crores. The gross NPA number came down from 9.32% last year to 6.87%. Remember, we are comparing on a YOY basis and not Q on Q because they have reported numbers in line with Ind AS accounting norms. Loan book growth has also come in at 24%, so largely good numbers. Shrey Infra also reported a good set of numbers. While the net profit grew or doubled to 139 crores, the provisions were more or less steady. Overall, the consolidated AUM has seen a growth of 24%. Disbursements have seen a strong 35% year-on-year growth. We do not have the gross NPA numbers. They've still not shared that. They've not put up the investor presentation. So based on the rest of the parameters, the numbers look good. Aside of that, the CEO has also stepped down with effect from 1st of September. So Devina, don't know how much of a bearing will that have on the stock, but otherwise, based on the other parameters, seems like a good set of numbers.
All right, Shraddha, thanks a lot for that. But it doesn't look too good for Z. I believe Morgan Stanley has downgraded the counter.
So Morgan Stanley has downgraded Z Entertainment to underweight rating from outperform rating, and they have cut the target price to 410 from earlier of 610 rupees, which suggests a potential downside of nearly 15% from the current market levels. They believe that competition intensity is growing in the OTT space, and to compete with global players like Netflix and Amazon, and also possibly large domestic players like Reliance Jio, will not be easy for Z5. Z5 will have to spend disproportionately on high quality content, as creating OTT content is more expensive than creating traditional TV content, and hence they believe that investments in Z5 is likely to drag margins in the near term by 3 to 5 percentage points, and hence they expect a possible break even for Z5 in FY25. They expect share of digital advertising to increase from 17% currently to 31% in FY25. However, this could slow Z's traditional revenue, which contributes a majority of the top line, which is nearly 63%, and hence the stock could be up for a re-rating if we continue to see losses from the OTT space.
All right, Saloni, thanks for that. And some more stocks in news, Nikki?
Yeah, so I'm going to start off with Bharti Infratel, where Vodafone Idea merger scheme got implemented from August 31st, and Bharti Infratel has come up with a notification on exit notices, where you mentioned about Vodafone Idea to exit around 27,000 co-locations with effect from September 1, 2018. These locations contributed around 13.7% of total co-location, and the exit is expected to result into a revenue loss of around 60 to 65 crore per month. However, the company has also mentioned that some of these losses will be mitigated by exit charges. Second on the list, we have Nandan Denim. We're expecting some sort of positive reaction coming in on that counter. The company has received a sanction of subsidy under Gujarat State Textile Policy, where it's expected to save around 65 crore on account of the subsidy, which will come in on account of interest and power right from the year starting December 2016. And the company is also entitled for a GST VAT refund, which is going to be to the tune of around 340 odd crore till 2024. We are also tracking two pharma stocks this morning. First one is Gsk Pharma, which is in search of a buyer for non-core brands. That's an ET exclusive, and the company is expected to mop up around 100 odd crore from this sale. And also we are tracking in Aurobindo Pharma, which is going to be acquiring dermatology and oral solid business from Sandoz, USA. The net sales of this business is around $1.2 billion as of calendar year 2017.
All right, guys, thanks a lot for that. So many stocks to keep a track of. Parthiv, just want to come to you with one pocket, which is the FMCG space. Last 3-4 days, you've been seeing heavy cuts coming into stocks like HUL. The valuations are correcting on the lower side. Do you see this as the right entry point for stocks like a Jubilant Foodwork and HUL and ITC?
we'll have to cherry pick some of the FMCG stocks because HUL, despite all the greatness that the company brings in terms of its long-term investment thesis, yes, certainly I think short to medium term, there are some headwinds, especially in terms of the inflationary pressures. And they've already done a lot of cost cutting, they cut on some ad spend, everything of that they've done, which has protected the margins so far. Last quarter was also a positive surprise in terms of the margins. Volume growth also, they're talking about very good numbers going ahead. But yes, I think probably if at all there were to be some sort of pressures in terms of the margins, I think recently they have certainly taken some price hikes in the soap division. We might see some valuations even from here slightly getting, I think, derated. So I think I would wait for more better entry points. But this is a sector that certainly we love. And I think one stock which is corrected heavily and I would like to take a notice of is Nestle. I think this as a company is extremely now bullish over the Indian markets. They've launched a lot of new products. They've gained back their market share in the Maggi segment. And also I think the management is very upbeat about the growth prospects of the Indian markets, for which they've done a lot of capex. So Nestle, I think, post this recent heavy correction is certainly going to be one of our favorite stocks for the FMCG basket.
Parthiv, something that I know you track very closely, and that's base metals. So now we just did a piece on First Word early morning about how the expectations of the deficit on aluminium is a lot lower than what it actually could turn out to be. Add to that the fact that the deadline of the Rusal conversations, October 23rd, and the raw material costs moving up. Do you reckon there is a chance for an upside surprise in aluminum prices, and could that only augur well for a company like Nalco, for example?
See, I think, Neeraj, my sense is that aluminium as a commodity in terms of the metals, I think the game-changing development can only take place if, I think, in most of the cases we have seen, steel is the basically metal which is used for manufacturing of cars. Now I think we know for the fact that aluminium is slowly and gradually taking shape in terms of its use in many of the manufacturing of the cars. If that were to happen at a very large scale, then I think it could be game-changing. But yes, you're absolutely right. With the supply that is taking place, I'm not seeing more upside in terms of the aluminium prices. I think here it's a sector where we'll have to focus on the cost leaders. And Nalco certainly, I think, with its alumina backing, and we know how alumina has been doing for all these companies, I think that's the key cash-generating element for Nalco. And I think Nalco also has fantastic prospects, low cost of production, except for the fact that it's a PSU and always will command a lower EV/EBITDA multiple vis-a-vis some of its peers like Vedanta or Hindalco. But certainly, I think what I would suggest is if anyone wants to play this basket, Vedanta would be a good way to play, because here you're not only getting exposure to aluminum and they have higher prospects for aluminum expansion going ahead, but certainly you're getting the benefit of zinc, lead, crude. So I think it's a basket of commodities. The stock has corrected massively. It's quoting below 5 times EV/EBITDA forward multiple, which I believe is very cheap as compared to many of its peers like BHP, Bullion, Rio Tinto. So I think Vedanta would be one of our preferred stock picks in this particular sector.
Okay, watch out for Vedanta. Parthiv believes this is a good price to probably have the stock in your portfolio at 229 for Vedanta. Let's bring in Sameet Chouhan. He's also joining in right now to take us through some technical ideas as we start off for trade this morning. Sameet, good morning to you. Let's start off with your Nifty call, and what's it looking like around that 11,500 mark?
Hi, morning. Since last couple of days, we have already witnessed a decent correction, nearly 250 points in Nifty from higher levels, and the kind of massive destruction that we saw day before yesterday and in the first half yesterday, that was not so encouraging. But toward the fag end, we witnessed a decent recovery in the index and in the broader market as well. And if we just look at the mid-cap index managed to pay down all its losses. So all these are encouraging signs, and as far as Nifty is concerned, it has already formed a bullish hammer pattern around its important support level. So directionally, yes, we were quite upbeat and we are still quite upbeat. It's just that after rallying nearly 718 points without any major correction, we did see some kind of profit booking. So now 11,400 has become a very strong support. So we believe that this would be a buying opportunity, and once we surpasses yesterday's high, we could see resumption of this uptrend. So as of now, for a day or two, our strategy would be to go long on index, keeping a stop loss somewhere around 11,390, and we would expect a move toward 11,550, 11,580.
All right. What about some stock ideas?
RBL Bank certainly looks good. This has been, one of the outperforming mid-cap private banking stocks. And, in last 3-4 days, the stock has corrected along with the market correction. But if I just look at it from a slightly broader view, the stock has now retested its previous breakout points of 590, according to us, should act as a very strong support. And, going ahead, we expect the stock to head higher. Immediate target would be around 618 and then 640. So RBL Bank would be a preferred choice with a stop loss of 579. And apart from this, metal counter, the metal space as a whole yesterday was clearly one of the outshining sectors. They were bucking the trend, and Vedanta is the one stock that we are certainly liking, considering its overall price and volume activity. So we expect Vedanta to head higher. 239 is our near-term target. It can be bought with a stop loss of 223.
Interesting. Just before we go on to Bloomberg Edge, Sameet, just one question. Yesterday, the Nifty Bank, revved up in the last 45 minutes of trade. And when I was looking at the movers, the principal movers, even though they were not heavyweights on the Nifty Bank, were Yes Bank and Axis Bank. I think both of those stocks went up in trade. Any chance of some upsides into either of these two names today?
Yes, Bank. The stock has corrected significantly over the past, few days, and it has reached its 200-day moving average, which placed around 330. So since last couple of days, the stock was hovering somewhere around those levels, and yesterday we did witness, some kind of buying it as precisely from those important support levels. So we could see extension of this move in Yes Bank, wherein the stock can head toward 355. But with a trading view, we still believe that Axis is the one stock that one should watch out for. The stock is clearly poised for a decent move. On the monthly chart, we have already witnessed a good price volume breakout a couple of weeks back. Stock has been consolidating, but the stock is clearly gearing up for strong moves. We won't be surprised to see this stock heading towards 680, 690 over the next few weeks. So as of now, Axis Bank certainly looks good around 630, 640. This becomes a good buying opportunity.
All right, so that's Axis Bank and Yes Bank that Sameet just spoke about. But on to a special segment, Bloomberg Edge, where Jayesh Kilnani tells us about a pattern that the Bloomberg terminal has thrown up on a stock or a particular trend that we've spotted. Jayesh, what's on your radar today?
Morning, Devina. It's one of the stocks from the FMCG space, which is Dabur India, and it has taken support near the 21-day exponential moving average, and yesterday it closed higher, from where the exponential moving average is, on good volume as well. First, let's have a look at the exponential moving average and how it is calculated. What are the conditions that you have to watch out for? It's calculated by giving more weightage to the recent data, and because of that, it reacts faster to what the recent price moves has been, and it's better suited for a trending market. So maybe the trend is likely to resume for Dabur India on the upside. Let's have a look at the chart of Dabur. That's a 6-month chart that you see. The green line is the 21-day exponential moving average. So what you see over here is the hollow candle, which means that the stock managed to open lower, and it has in fact crossed above during intraday trade and closed above the green line, which is the 21-day exponential moving average. Also, what you see on the bottom panel is the volume picture. Now, this is also on the higher side because it's more. Yesterday's volume is more than the 5-day average. So, yesterday's uptick along with good volume and also, the historical evidence that this works really well. So, in the last 1 year, if you had bought all the conditions when the stock closed above the 21-day exponential moving average, net profit on each of the trade was about 3% odd.
Okay. The success rate also, Jayesh, has been very good. Thanks a lot for putting this into perspective. So Dabur, and remember, just coincidentally, I might add, we have the management today at 9:30 a.m. So, that'll be an interesting conversation to have. They had a recent analyst meet and they posted some very bullish comments. So it'll be interesting to have a conversation with Lalit and Malik about it. Well, Devina asked Parthiv about FMCG already, so we'll avoid that question. But okay, I'm told Srikant Chouhan is with us. Srikant, while we're on the topic of stocks, we'll take your index view in just moments from now. But since we're on the topic of stocks, what are the stock-specific recommendations for this morning?
Good morning, Nikunj. Surprisingly, we also like Dabur, which is around 455, 456 levels. And yes, the way the stock recovered yesterday and the way overall formation of the stock in last few months, we feel that at every support, at every major support, a bank should emerge. And yesterday when the stock was down, very first in the morning it recovered and later on the market recovered. So it clearly shows that there is a specific interest for the stock. Yes, we can expect some consolidation because there was over retracement from the levels of 350 to almost 490, 500 on the higher side. So the stock will take some time, but currently it is available at its important support area of 440, 450, from where we are again expecting 480, 485 to achieve in the near term. So it's a buy at this price. And if there is a medium to long term view, then we are of the view that it is heading for the levels of 650 or 660. So it's a strong bet to buy. Along with Dabur, we also like Dr. Reddy, which close around 2570, 2560 levels. All pharma stocks are they are doing well, and in fact in last correction, in last 3-4 days, all these stocks have faced a very minor correction from their highs. There was hardly any sell-off. In fact, a lot of buying was there in stocks like Sun Pharma and Dr. Reddy. We feel that Dr. Reddy, which is around 2560, is heading for the levels of minimum 2700 in next 1 or 2 days of time. So it's a buy at this price with a stop loss at 2530, and the stock has also validated its long-term formation, I mean to say medium-term formation on weekly basis. So we are expecting stock is finally heading for the levels of 3050, 3100 in next couple of months.
A few other stocks that did well in yesterday's session, and I want to quickly get some chart checks going on that. Sameet, and coming to you, Biocon was up about 5%. We had a Subin Life that did okay for itself, 4.5% in a dipping market. And a Nalco, which was up about 4.4%, along with the Hindustan Zinc within the metals pack, which is up closer to 4%. Any of these stocks, Amit, the two names from the metal pack, that's Nalco and Hindustan Zinc, and the two from the pharma pack, Biocon and Subin Life?
No, as far as Biocon is concerned, the stock is more of in a consolidation mode. Yes, the stock can head higher, once it surpasses 630. But overall, we believe that moves on the higher side would be slightly restricted. So the stock has slipped into a consolidation mode. As far as Subin Life Sciences is concerned, any dip would be a good buying opportunity. The stock has been enjoying its strong bull run since last many weeks. But as I've highlighted in my opening remarks also, we are quite a bit on the entire metal space, which has been bucking the trend. So Nalco is the one stock, yes, we have been closely tracking, and the stock is clearly heading for a move towards say 84, 86. So a couple of weeks past, there was a decisive breakout from its previous hurdles of 72. Stock gave a decent move and again, came back and retraced its important support levels. And yesterday there was a smart move that we witnessed along with the decent volume activity. So that suggests that the Nalco is clearly heading for higher moves. 84, 85, these are the next levels to watch out for. One can go long at current level also. Risk reward is quite favorable, keeping a stop loss around 71. And Hinzing is the one stock that as a disclosure we have advised to our clients as well a couple of weeks back. The stock is poised for a move toward 327, which is our near-term target. One can go long at current level. Minor dip would be a good buying opportunity. Keep a stop loss around 288.
Okay. Some more stocks, and I think financials is an interesting pack as well. Hdfc Amc, after much fanfare and northwards of 1900 odd levels, has corrected quite a bit. I think it was circa 1700 odd levels as of yesterday. In fact, sub 1700, 1682. So there is a 10% correction in what is arguably the premium asset management company amongst the listed two stocks on the bourses currently. So that's come off. Edelweiss Financial Services, for all the strength that it showed in the quarter gone by, is down to about 255 odd rupees per share. So a bunch of these financial names are providing what could arguably be termed as opportunities. The only question is, you don't know how long the pain lasts. So, which is why I think a lot of our fundamental experts have been saying that even if you want to go out and invest in these companies, might be worthwhile to do an SIP based on, of course, what you like. And once we get Parthiv back, and once we have Parthiv, we'll of course talk to him about whether or not some of these stocks can be invested into or no. Queries that have come in on the auto component space as well. Remember, the Class 8 truck sales for the North American region the numbers are out, and it's 150% growth year on year as per one agency. So the likes of Bharat Forge, Ramkrishna Forgings, etc. could well be in focus today, could well react in the session today as well. On the chart, Shrikant, a Bharat Forge, or if you track a Ramkrishna Forgings, then that one. Or actually, there's a small cap company called Talbros Automotive, not really dependent on these numbers, but was active yesterday. Do you track any of these auto component names?
Yeah, Neeraj, we track Bharat Forge, which is around 660, 665. And the daily pattern of the stock is very clear that it is forming some rounding bottom sort of formation. The stock has corrected to its important support areas of 580, 590 when it was down in the month of July, and nicely it recovered from their immediate lows. So we feel that it is heading for at least 750, 760 next maybe a few days or weeks. It will take time because stock is having very low beta as compared to other stocks. But yes, eventually we are expecting stock is heading for the levels of 750, 760. In fact, the news flow on the defense front is also supporting to the stock. And we feel that if there is a medium to long term view, then also we should look for it, because the way there is a formation on monthly charts, I think the stock is forming higher top, higher bottom, and whenever there is a like restructuring or reversal kind of formation, we see a good amount of delivery based buying. So it's a buy with a short term as well as with a medium term perspective.
Interesting, Devina. Today these stocks will react positively in all accounts. I mean, it's one of the agencies out of the two which gives these numbers, but 150% YOY growth on the North American Class 8 truck sales should augur well.
Obviously, you're going to see all those stocks reacting in today's session. They've been doing well so far, like Shrikant pointed out, Bharat Forge in particular, over the last few months, not particularly in the last 1 month, but the stock has seen a decent move, 663 on Bharat Forge. The other one, we've got 16 seconds left to go for market pre-open, so I'm going to quickly first go across and look at Asia as a pack. Not much, in fact, just a slightly sharper dip coming into Shanghai from the 0.33% gains. It's now flat. You've got Hang Seng down about 0.5%. For SGX Nifty, that's still a 0.33% in the green. Nifty 50 at pre-open flat. You've got it at 11,483. Sensex also trading with gains of about 0.7%, 38,312, but that'll cool off. In terms of individual movers, let's quickly look at what's driving up and down on the index. So taking a quick look at some of the banks, you've got the likes of Reliance Industries, taking stock of how they've opened up in pre-open this morning. Reliance Industries is down 0.5%. You've got the likes of HDFC Bank as well as HDFC Limited, Adani Ports. Watch out for all of these stocks. HDFC Bank opens higher in the session. Adani Ports is up 2%. You've got Axis Bank up to 0.33%. Bajaj Finance flat. Bharti Infratel opens with a cut of about 2.3%. Coal India is down. Cipla is up about 1.6%. Eicher Motors is up 1.5%. GAIL is up about 0.7%. And you've got some cuts coming into some of the IT names like an HCL Tech, which is down 0.5%. Remember the TCS buyback window starts from today, so you're going to be keeping a close eye on that as well. HUL is up 0.5%. HPCL, Hindalco, Hero MotoCorp also in the green.
Okay. Let's pull up Ramkrishna Forgings and Bharat Forge and try and see if they are reacting to those numbers at all. No, not so much. Bharat Forge will be a better indication, about 1.5%, at least in the first 1 minute. Let's see if this lasts. Devina has already spoken about Bharti Infratel reacting, at least in the first 1 minute again. Let's wait and watch in the first 8 minutes bring out. Oh, no, I must say that's actually not a bad piece of news, because the price damage may already be done, but let's wait and watch what happens there. VIP Industries, after getting hammered the last couple of days, might be looking at some bit of salvaging of the stock price, 589, if the first few minutes are to be believed. I want to see what BEL is up to and what Muthoot Finance is up to. BEL got hammered in trade. Let's see if that is continuing. No, not quite. Muthoot Finance went up in trade, right now muted, and aviation companies should come up on your screen, and let's see if they are continuing with the corrective phase. Jet Airways was down, right now looking up. Interglobe Aviation got hammered 4.5% yesterday, currently flat as flat can be. SpiceJet too, flattish in trade. The currency and the bond yields will come up on your screen. 71.65, if I'm not wrong, is how the rupee opened. 71.69, so very flattish move there. The bond yields in and around 8%, 8.03, so no big changes out there either. We're not seeing big moves, to be honest. NMDC on the JP Morgan upgrade seems to be doing okay for itself. Speaking of JP Morgan and upgrades and downgrades, let's get in Sameet Sarkar, who joins in with the top brokerage calls for the morning. Sameet.
Good morning, Neeraj. On the big brokerage calls for the day, first we have a CLSA on Reliance Industries. Now, the brokerage has maintained its buy rating on the stock, but have raised the target price on Reliance Industries to 1,500 rupees from 1,365, which suggests a potential upside of nearly 22%. Now, the brokerage has raised the target price on Reliance Industries as it has removed the holding company discount on retail and the Jio business. Now, according to the brokerage, the grand omni-channel strategy of cross-selling retail products, telecom services, digital content may be a long-term promise for the stock and positive for the company. Now, CLA is expecting the Jio subscriber base to rise to around 400 million by March 2020, and these telecom subscribers will also be a ready customer for revenue and profit from other sources like ads, retail sales, service and content sales. Lastly, it believes that the high customer engagement will create a big market opportunity for Reliance Industries going forward. Second we have is JP Morgan on NMDC. Now, the brokerage has raised the rating on the stock to overweight from underweight and has also hiked the target price to 145 from 130, which suggests a potential upside of nearly 30%. Now, according to the brokerage, domestic iron ore pricing would remain strong going forward on the back of strong global pellet pricing and strong domestic steel pricing. It also says that currently the market is giving zero value to the steel investments of the company. However, the brokerage is assigning a 45 rupees per share value to these investments on the back as its capacity will be commissioned at an ideal time given the industry tightness and on the back of its low fixed cost and captive iron ore mines. Last, it also believes that NMDC offers an interesting option to potential mining disruption post financial year 2020.
All right, Sameet, thanks very much for that. The other stock that you should probably look at when we're talking about Reliance is ONGC. So pretty divergent in terms of the kind of stock market reactions that both these counters have been seeing, keeping in light what's been happening with crude oil. Remember, ONGC obviously focus of attention because of the government asking it to divest a little in OVL, transfer that money as a special dividend to itself so that it actually can meet its own divestment target. Remember, government's divestment in ONGC and Coal India together, they hope to raise about 20,000 odd crores. Don't know whether that will happen or not because they've just about reached 9,300 odd crores in terms of their divestment target, which is 80,000 crores. Parthiv and ONGC for you?
I think my concern for ONGC is, I think it has a double whammy. If the crude prices are low, it does not earn the proper realization. And when the crude prices crosses a certain threshold, the government expects to milk out more out of ONGC than what otherwise it should. And I think we know the fact this is a very, very capex heavy business model. No doubt ONGC has one of the strongest balance sheets, and I think a pure way to play upstream would be ONGC in terms of its sheer scale, size, and also its plans to kind of divest its subsidiary. But to be very honest, I think this is not the way we would like to play oil and the uptake in the oil. As I mentioned in the past, that playing via Vedanta, where they own the stake in Kane, wherein I think we know for the fact that they have this track record of upping the production, and Palmer is a fantastic asset that they have. The cost of production is abysmally low, and every $1 increase I think from here is going to benefit them extremely. So I think that's how we would like to play as a basket, not playing crude only via ONGC.
It's interesting, Neeraj, because ONGC themselves believe that right now is not the time for them to go ahead and list OVL because they've got giant gas fields in Mozambique, they've got gas fields in Iran. Once that starts production in 2022, that's the time where they can actually have unlocking of value and they can actually get more out of the listing. But plans of the government can't help.
Can't help, man. Well, let's see what happens on that front. May not have a big bearing on the stock price of ONGC, but interesting from a valuation multiple that OVL could get. In fact, let's get Amit Khurana, Head of Equities and Research at Dolat Capital, on this conversation as well. Amit, good having you. Thanks so much for taking the time out. What are you guys doing with this either upstream or downstream companies in light of what crude is doing, Amit? What have been the latest calls that you've given to your institutional clients?
Well, upstream, downstream companies obviously face a major headwinds as the crude oil price continues to strengthen and sustain at those levels. Particularly HP, BP have been facing the pressure, and our stance has been neutral to negative on these names. I must say that till now we've been positively surprised to an extent that the retail prices have been allowed to go up, and therefore the impact on the financials for some of these names may not be as negative. But going forward, we see a fairly limited scope for these retail prices to keep moving up, and eventually somewhere or the other a decision has to be made by the government on whether there is an excise duty cut on the crude and the petrol and diesel as a component, or whether these companies have to take a hit on themselves. So to that extent, our stance is turning even more concerning as we go along for the next few weeks. Our sense is that the next 1 month or so will show a decisive move either ways, and therefore it makes better sense to wait and watch. On the crude side, we still believe that the sustainability of this at these levels will prevail over the next few months, and therefore there is a risk of continued underperformance for the sector at large.
Coming to you, Sameet, are you tracking Sun Pharma, and is there a potential upside here?
Definitely, yes. In fact, since last 3 months, we have been closely tracking, and around 480, 500, we were contra buyers in this counter, and continuously we have been recommending this to our clients. Yes, from here on also this stock is heading higher. If I just look at the Nifty Pharma index, after forming a strong base somewhere around 8,000 3 months back, there has been a strong move that we have witnessed in the entire pharma index, and from here on also we won't be surprised to see Nifty Pharma heading at least another 10 to 12% higher. So we would be quite upbeat on the entire pharma space. Sun Pharma, yes, from here on the stock is clearly poised for a move towards 720. So any minor dip would be a good buying opportunity. Apart from this, Dr. Reddy is the one stock that we are closely tracking, within the pharma heavyweight counters. So Dr. Reddy is poised for a move toward 220, 2750, 2800. So Dr. Reddy, Sun Pharma would be a preferred picks at this juncture.
Okay, gentlemen, stay on. So much more to talk about, but minutes away from market open, let's tell you all that you need to know to stay ahead in trade today. Let's begin with two companies that reported earnings post-market hours last evening. Hdfc and Shrey Infra reported numbers that surpassed analyst estimates, and both of those stocks look like starting off on a positive note.
Bharti Infratel is staring at revenue loss of 60 to 65 crore rupees per month. This is due to the Vodafone Idea exiting 24,447 co-locations in September.
Nandan Denim has received sanction of subsidy under the Gujarat state textile policy. The company expects a saving of 65 crore rupees over a period of 5 years.
And Sagar Cement has reported robust sales for the month of August. Sales rose 24% to 2.47 lakh metric tons on a consolidated basis.
JP Morgan has turned overweight on NMDC. The brokerage house upgraded the counter from underweight. It has also raised the price target to 145 rupees per share. On the other hand, challenges on the OTT platform has led to Morgan Stanley downgrading Zee Entertainment to an underweight stance.
And lastly, TCS begins its buyback from today. The buyback will last until September 21st. Adani Enterprises will trade ex-Adani Gas from today.
Well, three interesting stocks though which are reacting. Parthiv, any thoughts here? Hdfc, Shrey Infra, or for that matter Nandan Denim, which has announced that it is eligible to get a lot of benefits from refunds and tax benefits.
See, I think if I have to comment on a stock like Hdfc, I think no doubt during the IPO, I think the management did brag about the fact that their capital adequacy is one of the highest in the industry, and as a result of it, the single-digit ROE that they had, I think that's going to expand. But frankly speaking, not a very big fan of a government-run NBFC, because we have seen what sort of challenges it has in the past, and a lot of, I think, the policy for the company is driven at the top government official level, wherein I think if they have to do something which is populist in nature, they will even force a company like Hdfc to do the same. But I think NBFC space best played with many other private sector listed companies. Case in point being something like L&T Finance Holding, which after the recent correction, I think looks extremely attractive. Something like a basket play like an AB Capital, I think after this massive correction that has seen, I think looks good. These are the type of quality stocks which would like to be added to the portfolio and ride this wave for the next 3 to 5 years.
Amit, are you a big fan of the NBFC space? And the other pocket that probably has seen a bit of valuations correction in the last 3 or 4 trading sessions has been the FMCG pack. Do you see value at entry points here?
Well, not yet, I would say. We've been big fans of NBFCs as being the key beneficiary of the inactivity of the PSU banks. So essentially, the incremental lending that we've seen in the Indian markets has been led by the NBFCs, large NBFCs in particular. Our concern for the next few months is the rising interest costs for these NBFCs and their, ability, how much can they pass on, we'll have to wait and watch. Especially these small and mid-sized NBFCs, we see a serious pressure on the net interest margins for the next 2 to 3 quarters. The larger ones may still be able to pass it on based on their strength of the franchises or based on their ability to manage the risk better. But somewhere in the small and the middle category, we feel there is now a case which one may see of a pressure on the NIMs. And that, I think, readjustment is yet to go through. Essentially, that may have already started with the way the yields have moved up and the way the prices, the valuations for some of these names have corrected in the last few weeks. I would still expect some more scope to sort of correct these valuations and possibly see the impact as to whether RBI does one rate hike in October or is there a possibility of another one coming in December. I think that will determine to a large extent whether we are closer to the bottom range of these valuations or not. At this stage, we don't think there is possibly a risk to that.
All right. Just stay on with us, gentlemen. Time to take our top technical calls. We're about 52 seconds from market opening. Let's start off with you, Shrikant.
Yeah, we like pharma space, and I would like to go with Dr. Reddy, which close around 25, 65, 70 levels. Here we are expecting stock to move towards 2600, 2620, and stop loss level is also nearby. With a stop loss at 2530, we can look for adding long position in Dr. Reddy.
Sameet, what about you?
I'll stick to outperforming mid-cap private banking stock. RBL Bank looks good. Stop loss around 579, and one can keep immediate target of 618 and eventually 640.
Shrikant, less than 10 seconds. Yeah, Nifty, you are initiating a long position very quickly.
Yeah, let's say if it is opening around 11,500, then certainly yes, because 11,570 is the next level to watch out for.
This is how it's opening. So 11,509 for the Nifty. It's open at about 11,500. Sensex about 38,138, up about 120 odd points, and the Nifty Bank about 0.25%. So yesterday it was raring to break into the green on close. For now, it's starting off about 0.25% higher. What about the mid caps and the small caps? Should come up on your screen. Well, a brisk start, not a bad start really for the mid-cap index in particular, 135 odd points higher. The small-cap index about, 0.5%. So, good start in the green. Bring up the heat map and let's show you what's moving. Well, a lot of stocks moving. Z, presumably reacting to the Morgan Stanley downgrade. So that is that one stock which is in the negative, and Bharti Infratel about a couple of percentage points lower on account of this news flow that has come in. I might add that analysts believe that it's actually good news that what's happened. Nevertheless, the stock starts off lower. What's doing well? Ultratech Cement got clobbered the last few days, up about 1.5%. Tata Motors had a good day in trade yesterday. I might add Tamo and Tamo DVR up about 1% again today. HP BP marginally higher in trade. No big winners, but a slew of stocks moving up in tandem, leading to the markets marginally the green. Actually, that green has quickly evaporated and we are trading absolutely flat for the Nifty. Before I hand it over to Devina for figuring out what's moving across, just a couple of trends that I do want to highlight. Some stocks in news and some movers from yesterday's session. So firstly, this North American Class 8 truck sales and the impact that it would have had. Bharat Forge, Ramkrishna Forgings, remember, YOY growth of 150% as per one of the agencies. The stock start off 1.5% higher. What about top movers in trade yesterday? BEL went down. Is it continuing? Yes, it is continuing to fall. So BEL about 1.5% lower in trade today. Muthoot Finance continues from where it left off, another 1.5% higher. Sikal Logistics was up and about in trade. No such luck in today's session. Last but not the least, we are talking about brokerage notes and JP Morgan upgrade on NMDC, and that stock starts off a couple of percentage points higher. What are you seeing, Devina?
Smaller names, we had Shree Infra reporting numbers. The stock's open positive by about 4% right now. And ACC is doing okay, up 3%. You've got Radico Khaitan, which is up 2.8%. Prism Johnson trading higher by 2.7%. HDIL, which has gained about 2.5% as well. I want to pull up yesterday some big gainers, Texmaco, Python, McNally, Bharat. Both these stocks were driven by news yesterday, and to see whether they actually carry on these trades today as well. So 3% higher Natex Mecopipe. McNally Bharat also doing okay for itself, about 3.5% on an order win of about 108 crores. IOB is up 2.3%. TTK Prestige is up 2%. Praj Industries, you've got United Breweries, which is trading higher. Yesterday, you had Subin Life doing well. Today, again, it's carried on its momentum, 1.6% higher. Marks and Sparma, 1.5%. You've got the likes of Bombay Burma, Divi's Lab, MRPL. These are all stocks which have gained about 1% apiece. So in terms of the breadth, at least in the mid-cap index, it seems to be more positive than negative. Among some of the losers, with the biggest cut coming in Monsanto, is down just 1%. And others like Deepak Fertilizers, JP Associates and Berger Paints lose about 1/3% to 0.5% apiece.
Well, Z is the one which is starting off really negatively. Quick opening thoughts. Shrikant, sorry I had to cut you, but we hadn't asked you on Nifty, which is why I asked you that question. What are you doing on the index? 11,495 currently on the spot. Couple that up with a quick call on Z Entertainment that started off 4.5% lower.
Yeah, see, like Nifty is going to remain in a range maximum 11,545, 570 that we are expecting on the higher side. On the downside, 11,470, 450 is going to act as a very good support, and I think the market is going to spend some time. So if there is any decline, and initially there was some decline, so it's a buy call on Nifty with a target of at least 11,570 on the higher side, and we can place stop loss somewhere close to 11,450 based on spot levels. For Z, our view is that it is like falling, and it is like falling to its extreme levels. But if you like just go through with its last 6 months or 12 months chart, then close to this 460, 470 levels, number of times stock has like fallen and it reversed back. So currently we are of the view that if there is a medium to long term view, then start in fact looking for taking some contra call and investing in this particular stock with a target of minimum 550, 560 on the asset, which is decent upside that we can expect. And towards the end of the year, we are expecting a lot of momentum and activity in all media companies. So we are specifically keeping close watch on stocks like all the media companies, and there we are expecting to rebound from their lows. So on Z, our view is to take a contra call of going long.
Okay, a contra call on Z to go long at these levels at 459. The stock's down about 4.8%. Just want to come to you, Amit, within the metals pack, particularly stock with the aluminium flavor. We've spoken in the morning of how prices are likely to move up, and beneficiaries, could come in the form of Nalco being one key beneficiary out there. Do you track this space, and do you believe that there's value in investing within this pocket?
Well, yeah, this is one of the few sectors where we're finding now value emerging, definitely there seems to be a better placement for non-ferrous segment versus ferrous. So we are backing up the aluminium space in particular, and there we definitely like Hindalco also as a name. If you look at the overall placement of the company, I think there is a strong sort of tailwind which will emerge. Likely debt reductions over the next 12 to 18 months, and the support of the alumina prices. We definitely believe there's a much lower downside to Hindalco from a valuation perspective. Nalco being a primary producer, of course, will benefit, but not as much as an integrated player like Hindalco. So we definitely like the space. And that's where our stance is. I think there is also a case which is building up for steel to start performing sooner than later, as the the dollar rally gets a little more normalized, and the prices start moving up, and especially the domestic Indian prices have been relatively stronger. If that continues to sustain, I think steel will probably also have a case to play, but that's more from a domestic demand perspective rather than global as much.
By the way, it's not just Z, which is now down 5.5%, but Dish TV, Sun TV, and a bunch of other media names which have come off. Amit, I know you guys have very active coverage on this pocket, predominantly the exhibition space, but the media pocket at large. One of your peers has gone out and downgraded Z Entertainment today. The stock has fallen about 6% now. Any views on some of these media houses, and as a stocks, as an individual investment opportunity, how do they stack up?
Well, we've been negative on Z for the last 3 quarters odd, and our concern was essentially the valuations were not reflecting the optimism or the ground level picture, which we thought was not as great to deserve those kind of valuations. Having said that, the stock has corrected, so somewhere, while we're not taking a review of this, but somewhere I think it will probably start getting into a zone which may be not as negative stance that we've had. We've always favored the exhibitors versus electronic media, which continues to face muted ad revenue growth rates. Most of the growth is being driven towards the digital side now, and that has been one of our key concerns on the space. So not surprising that the valuations are correcting. We've had that stance for some time now. I guess it's playing out reasonably well, and somewhere down the line we'll probably take a review as to how the second half visibility on ad revenue growth works out and probably revisit our stance.
All right.
Okay, sorry. Yeah, what I meant was not CLSA but Morgan Stanley, which has gone out and downgraded the stock. So
it's funny because yesterday we had a note on CLSA which was talking about the entire media sector, but they are actually positive on Z, saying that the Z5 platform, the digital platform, will do well, and many of the players, particularly which are content heavy, are likely to do well. So for them, Z seems to be a good bet in that space.
Yeah, so, well, horses for courses.
Yeah.
If you're a Morgan Stanley client, maybe you didn't like it that much. If you were a Dolat Capital client, maybe you went out and got out of Z some time ago and could be entering a value zone as well. What else? By the way, Nalco has given up some of the losses, given up some of the gains. It's starting about 2.5% lower. Hutco, though, 8% higher in trade, results impact there. Indiabulls Real Estate 4% higher, and Ambuja ACC are looking slightly strong today, 3.5% higher, 3% respectively. Ultratech on the index has done well too. Parthiv, any cement names that fit the bill? And, I mean, with the presumption that you are looking at accumulating any cement stock currently.
Certainly, Neeraj. I think South-based cement players, especially efficient player like Ramco Cements, I think this company will certainly see a good amount of pent-up demand. Unfortunately, due to the Kerala floods that took place, I think certainly they're going to enjoy that pent-up demand. They have a strong positioning there in the south, and this pent-up demand is certainly going to come. A lot of destruction has taken place, and a lot of new housing development will take place in terms of the rehabilitation. And I think certainly we're going to see Ramco Cement take a lot of market share out of that. Their EBITDA by ton, I think, will improve. Yes, there were pricing pressures thanks to all the raw material input costs going up, but I think for an efficient player like Ramco Cement, they will maintain their cost leadership. They have some capex plans. They have some additional clinker capacity coming up, especially in the eastern segment of the country. But overall, I think it has corrected a lot, and I think the valuations look a little better for a longer horizon type of an investment. So Ramco Cements would be one of our most preferred picks in the cement sector.
All right, Parthiv, we'll leave it at that. Thanks very much for joining, and really appreciate you taking out the time this morning. Sameet, before we let you go, anything that you probably believe is a good sell at this point, which could see further downside?
See, we have been closely tracking, Maruti since last 3-4 days. This has been just one of the outperforming stocks since last many years. But in last couple of months, the stock has been struggling at high levels. And 3 days back, there was a decisive breakdown from its important support levels of 9,000, which coincide with the 200-day moving averages as well. So that's not that encouraging signs. And from here on, the Maruti can expect a decent correction from current level, wherein we can see the stock sliding toward 8700, 8650. So one should go short on minor bounce back. The stock has already corrected. It is now consolidating. So around 9000, 9050, it becomes a good shot.
All right, Sameet, we'll leave it at that. Thanks very much for joining. And Shrikant, thanks to you as well for taking out the time and being with us this morning. Both are technical experts there with their calls on stocks and the index. Amit, want to come to you on the IT basket as a whole right now, and your picks within there from the mid cap or the large cap space that we're seeing, and for TCS in particular.
Well, we like the IT space. I mean, we upgraded that about 3 quarters back. But what we have essentially preferred to play is the valuation gap. TCS Infosys fairly well captured on valuations. So we preferred HCL Technologies as the large cap names. And recently in our preferred picks universe, we've included Tech M. Tech Mahindra, one of the reasons we like is that most of the bad news is in the valuations now. We see very limited downside risk. And as the environment for their key vertical, which is telecom, gets better in terms of 5G implementation across the global markets, we see a much better visibility of earnings. Add to that the benefits of rupee depreciation. So while we did have some concerns around the way the news flow was happening earlier before the Q1 earnings of attrition happening or involuntary attrition being triggered, I think those concerns essentially led to a valuation zone wherein it was fairly capturing all the negatives. So that's where we included the stock in our preferred picks universe, and we continue to maintain that. On the mid cap, we have a preference for persistent systems because we believe that the next 12 to 18 months, the delta for an operating margin leverage to play out is far better for persistent than some of the other mid cap IT names, which are quoting at, some of these names are actually quoting at a reasonable premium to the large cap IT. And therefore, we are preferring to play again something which is not as expensive, but has a better potential to show up in terms of performance. So that's how we are playing out the IT pack. HCL Technologies and Tech Mahindra in the large cap, and we prefer persistent in the mid cap IT space.
Okay, Amit, pleasure having you. Thanks much for taking the time out and joining us today and giving us your thoughts. Really appreciate your time. That's Amit Khurana of Dolat Capital with his thoughts on the markets in specific pockets. Take a break on that note, on the note that the markets are lying absolutely flat. But a pocket which has now suddenly emerged as the topic of discussion, staples. We discuss about that pocket at large and Dabur's individual pricing and product strategy for the upcoming festive season with CFO Lalit Malik. And Varroc Engineering came out with June quarter earnings yesterday. The first report after listing. We decode the numbers with their CFO, Mr. TR Srinivasan.
Good news, got a promotion and a damn good raise.
Congrats बेटा.
वाह, रेज अब तो इंश्योरेंस पॉलिसी ले ले.
कौन सी कंपनी से लूं?
चूज वही जिस पर हो पूरा भरोसा.
That's good. But आज की generation wants everything online. Easy premium payment options, loan facilities और wide range of products.
पापा दीदी, I will decide. Just send your links now. तुम दोनों भी ना. Same choice. LIC.
LIC trending with times. 62 सालों से हर generation की पसंद.
The heart wants what it wants, and mine has led me to some amazing highs and lows as I followed its guidance from software development to investment banking and then into my own startup. I am Ahmed Aftab Nakhwi and my journey has been a roller coaster ride. When I started my company with a single laptop in a garage and 2 friends armed with just the burning desire to create something, I had no idea that we would create a whole new paradigm of marketing. Today, Gozoob is at the forefront of the industry, a thought leader in the space, and voted as one of the best places to work for in India. But we didn't get there quickly. But everything taught me and engineered our success. It's an interesting story, and I'm really looking forward to sharing it with you.
Aegon's of business never stop. Only on Bloomberg Quint.
September 15th, 2008. The day a titan of the investment banking world fell. An event so unlikely that when it happened, it shook the world economy. 10 years later, the world has picked up the pieces. Or has it? Bloomberg Quint looks back at the collapse of Lehman, its aftermath on India, and the recovery that followed. Lehman, a decade later, starting Monday, September 10th, all through the week.
Back with Indian Open right here on Bloomberg Quint. Dabur India has seen a steady rise in volumes for the past few quarters, and while competition is only heating up, demand has only grown. The big question though, will demand last, and are consumers willing to spend more for their purchases, not just for the current festive season really, but for multiple quarters ahead? What does the future hold for Dabur? Lalit, Malik, the CFO of the company, joins us right now to talk about that and a lot more. Mr. Malik, good having you. Thanks so much for joining in. Now, a lot of questions about the here and now as well, but just a brief thought about whether you, sitting in the chair that you are at and looking at Dabur not just for the next 9 months, but arguably for the next few years, do you believe that on an average, the growth numbers that the industry has been enjoying right now, give or take a few percentage points here and there, are possible for you as a company and for the industry that you are in to enjoy for an extended period? So the next 2, 3, 4 years, are you looking that far out?
Sure. So I think I'll just clarify in 2 points. Number one is what we saw in Q1 was primarily on the lower base. So even as an industry, we have seen a very healthy growth in Q1, but the base was low in the last year on account of pre-GST. Having said that, I think what we have seen is a positive consumer sentiments. We have seen the demand steadily getting back and increasing. We have seen consumer confidence coming back, and specifically on the rural sector, we have seen good demand growth coming up. So if we look at for the next couple of years, we see 2, 3 things. Number one, we see the market size will expand because more and more products will come, more and more consumer will come in the market. Second, the purchasing power will go up given the fact that all the fiscal incentives are being given to rural sectors and to the medium and the lower middle class people. Those incentives will add to their purchasing power. Third, I think we are dependent a lot on monsoon. Though the monsoon is slightly lower than expected, but it is overall very good monsoon that we have seen. So if the monsoon remains good, the demand also comes back and it increases. Number 4, I would say, is that in view of the telecommunication network getting expanded, the awareness of the new product, the benefit and the value that consumer can expect is actually getting widespread across the population. And considering that we have a strong young population who have aspirations to get good products and value for money, there would be a positive demand in next couple of years as we see here.
So, my colleague Agam had this one pressing question. Are these 15 to 20% volume growth numbers sustainable for the rest of the year?
See, when we look at the growth number, as I said, Q1 has been with a lag based on the lower base. But going forward, we certainly expect our volume growth to be within the range of 10 to 12% or lower double digit on an annualized basis.
Are you being cautiously optimistic out here? The reason I ask this question again, Mr. Malik, is when I look at the bunch of notes that came out after you had the analyst meet, almost everybody seems to be believing that growth obsession is the new mantra when it comes to Dabur.
Well, I think certainly we are looking at the areas where we could have growth coming up. And we have been gaining market share, and that has been our strategy to gain the market share and reach out to the large population through strengthening the distribution network, to supporting the product with the promotional investments, and to come out with the new product launches. So we certainly are going to look at all opportunities of growth and work towards it in a strategic manner. And having said that, I think we have also to be realistic in terms of the overall demand scenario in the country, and therefore the right balance is absolutely essential.
So where does this balance come from? I believe you've done some launches in the fruit drinks, hair oil, toothpaste segments. If I look at the rest of the year, Mr. Malik, and not necessarily 2 years, 3 years out, would it be a higher thrust on the new launches, which a lot of people term are practical as well, which will drive this added growth for you as a company, or would it be continued momentum in the existing categories which will get you there?
Well, I think I'll again answer this in two parts. Number one is that whatever are our new product launches in last couple of years, we would be giving lot of support in terms of promotional investments to raise the level of its revenue earnings at a very respectable level, and we will be selecting 2 to 3 products every year, and we will go after it by investing a large amount on promotion to increase that. And on this other hand, we will be also coming out with the new product launches from time to time, depending upon the readiness of market and seasonality, and we will invest into those new product launches also, but that will take time before it comes to a respectable level of volume growth. So there would always be a gestation period for those NPDs.
Interesting. Now, Mr. Malik, you in the meet, which was what, about 10-15 days ago, as the case may have been, you've also reiterated your confidence of how not just for the rest of the year, but going ahead as well, there could be a moderate uptick in profit in the operating metrics. The operating profit margins could expand. I'm intrigued to know how would this happen. The deflationary benefits of raw material costs have probably come to a halt, and if at all there is some inflation in raw material costs. You've spoken about new launches and promotional activities, and therefore arguably higher ad spends as well. This is my presumption, of course, and please correct me if I'm wrong here. If both of things are happening in tandem, would volume growth alone take care of recovering all of these costs and still posting a better operational number?
Well, I think as far as our operational margins are concerned, there is certainly pressure on inflationary aspect, and also considering some aspect of an exchange on the margins. However, we are going to make all efforts to absorb it through our synergies and cost efficiency initiative measures. At the same time, in case of the extent of inflation to select categories, we may also consider the price increase also. So therefore, keeping all these things in mind, our efforts will be to maintain our margin, if not grow, and our efforts will be to bring synergies and select price increases in order to maintain our margins.
The price increase be a factor of raw material costs alone, or do you reckon if demand is looking very strong, as you reiterated, the rural demand is looking strong, would that allow you the leeway to go out and hike prices in order to improve profitability? Mr. Malik?
Well, I think the price increase, as I said, is going to be at a very selective category wherever there would be necessary for us to pass on the price increase pressure after we have absorbed efficiencies. But that will be more on a selective basis, and considering the competitive environment in mind, and also the overall economic growth as we see going forward. So based on those parameters, we will be taking selective price increases, not in many categories.
Can you dwell on that a bit, the competitive intensity? Because again, I believe in the said meet, you spoke about how there has been some moderation in the competitive intensity, maybe led by Patanjali, which probably to your mind emerged more as a distraction and not a disruption. How has the experience been while dealing with what is arguably created a mindset of its own in the rural areas with the herbal products? An area that was entirely yours at a point of time, but now having competition too, but you believing that the competition intensity has moderated a bit. Can you take us through how that piece or that experience has been the last 12 months?
Sure. So, as you rightly said, Dabur has been into the Ayurvedic category for more than 135 years. But what we have seen is, with the emergence of the competition, the overall awareness and acceptance of Ayurvedic as the medicine to prevent and cure has actually gained a lot of acceptance, and the market size of the Ayurvedic product has actually expanded. So as a result of it, since we have a very strong R&D, and we have products which are of high quality standards, and we are there for last 135 years, there is a strong trust that is there with the brand Dabur, and as a result of it, the direct benefit of that has come to us, considering the market size has expanded, and within the market size we have gained the market share. So as a result of it, there has been a benefit of the Ayurvedic advantage that we have got, and therefore even though in the small short period of time there has been some impact on few categories, but overall it has been a great benefit to us in terms of expanding the market size and market share.
Yeah, but can you dwell a bit on why do you believe that competitive intensity has moderated a bit from Patanjali led essentially?
Well, I think, sure. I think if we talk about Ayurvedic, certainly it has moderated, but competition is always there in other categories also. Like we have seen in juices, there have been many players entering, considering the fact that there is more preference towards the healthy fruit drinks as compared to the other aerated drinks, etc. So yes, I think the competition has always been there, and we have been very careful in terms of having our focus on our quality and the value that we offer to our customer. At the same time, strengthening our distribution network. We have been always working in light of the competition to gain our market share and expand our portfolio.
Okay, I have last two questions, Mr. Malik. One is, again, I think the thing that you reinforced, the change in mindset that I think a lot of people are talking about, and I don't know whether it was an actual change that you kind of covertly or overtly indicated, but everybody seems to believing that the aggression in gaining and defending the market share that you have at any cost seems to be the standout feature. Now, would you defend market share losses if they were to come about through innovative methods alone, or if there is a need to take any price-based action, you would not deter doing that either? What I'm trying to gather is, what would be the preference for the next 9 months? Would it be market share or would it be margins? And part two of my question would be, would you need to, I mean, do you believe that the era would be like that, where you need to take an either or call, or both will happen simultaneously?
Well, I think one has to balance between the two, but certainly our preference is going to be to gain the market share, and if we have to go after the competition, we'll certainly will take all the necessary action in order to gain the market share. So that certainly is going to be our priority. Having said that, we will also keep our focus on the margins. Maybe in the short term there would be a margin sacrifice, but at least in the medium to long term, our efforts will be to have sustainable, profitable growth, and all three are very important in terms of our growth strategy going forward.
Interesting. My final question, Mr. Malik, as is for maybe a bunch of other markets, the US markets, for example, and because they got some benefits on the bottom line due to tax cuts, and therefore calendar year 18 for them has been an abnormal year in the sense that there is an extraordinary effect on their bottom lines. For our markets, as you said, quarter one, there was a low base effect which led to volumes moving up and therefore profitability moving up for a lot of spaces, including yours. So let's assume that FY19 is a bit of an abnormal year, which also benefits from a low base due to GST and not enough growth any which ways which were there in the non-GST months as well. What happens in FY20 when you have a normalized FY19? Would growth rates come down materially, or would they only normalize, which would be a par for the course correction of 2-3% on the volumes front or thereabouts?
Well, I think if I look at FY19, quarter one has been aberration, and quarter two, I think it is coming back to the normalcy, and thereafter it will be a normal growth that we will see. Coming to FY20, I think except I would say for the quarter one impact that we saw in this year, it will all be a normalized growth that we will see. Having said that, we should keep in mind that will be the election year. So there may be a small fluctuation on account of that, but overall FY20 will see the normalized growth scenario as we go forward.
Okay. We wish you all the best for that, Mr. Malik. Thank you so much for taking the time out and joining us and giving us the details about what the next few quarters could look like. Really appreciate your time. That's Lalit Malik of Dabur, speaking at length about what could happen not just in the near term but the medium term as well. Remember, FMCG stocks have been under a bit of a cloud the last couple of days, not because of any other reason but for some valuation multiples getting corrected. never know how long it will last. For now, the market seems to be stable. The FMCG names also don't seem to be under any major cloud. Varroc Engineering is the other one. Remember the stock, interesting because it rose about 15-20% in the last 1 month. It's a company into engineering which has got some marquee clients which include the likes of Tesla, but chunk of the revenues coming from Indian automakers like Bajaj Auto, which has recently seen a bump up in sales as well. What's also working in Varroc's favor is the shift to a more premium feel for Indian cars. So how do these factors translate into the bottom line for the company? Joining us now to talk about that, as also the quarter gone by, is the company's CFO, Mr. T.R. Srinivasan. Mr. Srinivasan, good having you. Thanks for joining us on Bloomberg Quint. This is Neeraj here. Good morning. Would you sum up the quarter for us?
Thanks for having me on the show.
No, pleasure having you. Would you sum up the quarter for us? Because the revenues looked strong, the margins probably not as much, as a result of which the bottom line looked, to my mind, absolutely flat.
Okay. It's a fair observation. The quarter gone by has been quite satisfactory from our perspective. So we had a strong top line growth. On a reported basis, we grew 20% on revenue terms. But on a comparable basis, the growth was even more robust, around 29%, adjusting for two effects essentially. One is the first quarter of last year, before the GST was rolled out, excise duty was part of the revenue, our revenue in India, which is not the case this year. And the second was in our global lighting business, in our North America operation, we had an operation on the interior plastics business, which was a legacy business, which we inherited when we acquired the lighting business, which was non-core for us. And that operation was wound up during the year and phased out. So we had some revenues on that during the first quarter last year as well, which are not there this year. So adjusting for that, top line grew by 29%, which is a very robust growth. And the growth was quite balanced between our Indian business and also the global lighting business. We grew about 28 to 30% in both the businesses over last year. So that way it has been quite satisfactory. All the various initiatives we have been putting together in terms of growing our product and technology portfolio, growing our geographical footprint, increasing our wallet share with key customers, all have been paying off. Again, on the operating margin side, the margins have been stable, adjusting for the one-off things that I mentioned, and some costs relating to the new facilities that we are putting up currently in Brazil and Morocco, which will get commissioned towards the end of this year, and an acquisition we did in Turkey early this quarter. So, and some higher launch activity, which also we had in the global lighting business. So adjusting for this, our margins have been kind of stable. What you see in the net profit level post-tax is been marginal growth, mainly because of the impact of tax. The effective tax rate this quarter has been higher. Combination of two factors. One is our share of profits from India, where the tax rate is higher, is the share of profit has gone up. And secondly, in our Czech Republic operation, which is a part of our global lighting business, we had significant tax credits in the first quarter last year, which we will again be availing this year based on our capex, but the timing wise it goes into the later part of this year. So adjusting for that, I think we have had a fairly satisfactory quarter, I would say.
Okay, so your revenue growth, key positive, it's tracking ahead of most estimates, at least the couple of brokerage notes that I read and what my analyst suggested as well. I'm just trying to think out, Mr. Srinivasan, the reason why the uptick in revenues didn't trickle down to the margins, maybe due to the startup costs at Morocco and Brazil facilities, higher cost of electronics on new launches, a bunch of these factors. They don't seem to be factors that will be contained in a quarter. They probably last for 2 or 3 quarters. Are we to see these impact like staying put for the next couple of quarters as well, or could they be topping out?
Yeah, so we will be tapering down over the next couple of quarters because the bulk of the startup activities for the factories has already taken place. So the remaining costs, which most of the remaining costs will get capitalized, and the Turkey acquisition, of course, has been completed. The launch activity again was heavy in the beginning of the year. As those activities stabilize and support the increased volumes, that impact also will come down. And the other factor I talked about, which is the phasing out of our interior plastics business, also was wound up during the quarter. So you will see that impact less and less in the next 2 quarters. So this one-off factors would gradually fade out in the next 2 to 3 quarters, and you will see operating margins coming back. Should see it coming back quite strongly.
What's the average that you bake in for FY19, Mr. Srinivasan?
Average in terms of?
Average operating margins. You have had a weak Q1. You will see some improvement in Q2, Q3, which will probably show full-blown in Q4. What's the average operating profit margin?
Yeah, I mean,
ballpark.
Last year we had reported EBITDA margin of around 9, I think for the full year, close to 9%. And we expect that during the year it will improve, and we are targeting improvement of 40 to 50 basis points. So that's our target, which will be more visible towards the later part of the year.
Okay. Would the India business help as well? Because I think you didn't pass on all of the input cost pressures, which if you managed to do, or which you already managed to do in the quarter thus far, it should probably show in the operational metrics on the India business.
Yeah. Actually, the India business already had better margins in the first quarter compared to last year. EBITDA margins grew by 40 basis points in the India business, mainly driven by the top line growth of 28% we had. So what has kind of held back the margin improvement a little bit is the increase in the raw material cost, which is a combination of, let's say, the metal and crude related inputs like polymers strengthening, as well as the depreciation in the rupee, combination of that. And in our business model, there is a time lag with which we pass on these increases to our customers. And the time lag ranges from 3 to 6 months for depending on the customer. So you will see that impact also will moderate in the later part of this year. That's why I'm more optimistic of the margin improvement in the later quarters.
Mr. Srinivasan, one final question really. You are doing a bunch of things here. I mean, one, you have a few startup operations. You're setting up, I think, if I'm not wrong, 4 new plants in VLS, which arguably will be operationalized by the end of FY19 as well. So a bunch of things happening within your company. Are we to see a bit of a J-curve effect onto your top line numbers over the course of the next 3 years, that you ride a particular percentage or a particular revenue number, circa a few 100 crores here and there for the next 2 or 3 or 4 quarters, and then suddenly there is a big bump up that comes in one particular year?
See, in the global lighting business, currently we are the number 6 in terms of market share and size. And our ambition, stated ambition, is to be one of the top 3 players, which will mean a significant growth we will need to achieve to be able to realize that ambition. So all our business plans and are aligned towards that. So out of the 4 new factories that you mentioned, 2 are currently under construction, which will get commissioned towards the later part of this year. And the other 2 are still just have been approved by the board. So activities to set up will start later part of this year, but will go into FY20 thereabouts. So definitely we see big opportunity to grow the revenues across geographies and also with key major global OEMs, where we have won a number of programs in the last 12 to 18 months, which all will get operationalized in the coming 2 years. So definitely we are on the right track in terms of the growth, and we are also actively looking at any inorganic opportunities which may come by.
Yeah, but you still didn't answer my question, Mr. Srinivasan. Would it be a J-curve effect that could come in? And the reason I ask this to you is if I look at the Citi report, they talk about how the net profit for FY18 annualized about 450 crores. Their estimates are that 2021, FY21 or 2021 as the case may be, your profits move up to not or near about 1,000 crores, which is at least 900 crores, which is almost double of what you did in FY18. Right. So in 3 years, your bottom line could actually double, which would indicate that there will be a J-curve effect that will come into place. When does that happen? Does it happen in FY20? Does it happen in FY21?
Yeah, so FY20, FY19, the current year, and FY20 is where we are making a lot of investments, setting up capacities, which will get commercialized and get ramped up. So FY21 probably is a year where we will have the full benefit coming to the bottom line.
You believe these numbers are on target? You could do northwards of 900 crores of net profits in FY21. Is that an internal target too?
See, that's not for me to say. That's for the analyst estimate, which we respect. So they are very well knowledgeable.
Good estimate
about the
based on some
industry.
guidance given by the management, isn't it, Mr. Srinivasan?
I wouldn't like to comment on that. So they are experts. Their knowledge of the industry is very strong. So we respect that. We have our own internal plans, against which we are tracking well, I would say.
Okay. We wish you all the best for all of these commissioning of plants and more, Mr. Srinivasan. Pleasure talking to you today. Thank you so much for being with us on Bloomberg Quint.
Thank you so much. Thanks for having me on your show.
Well, that's Varroc Engineering, a confident management at that. Margins will scale up at the end of FY19 is what they have tried to say in the last quarter, presumably. With that, it's a wrap on this leg of Indian Open. The market's in fine fettle. FNO Show will take all of that forward. Thanks for tuning in.